your question about the gold-silver ratio, I think we're going to see it fall further. I think we'll see it fall quite significantly. I mean, I wouldn't rule out at all. In fact, I would expect it to move back down to around about 50, which has been some sort of average over, really since about 1900, I suppose, or the 1880s. Because it was in the 1870s when silver was no longer, the silver standards, if you like, no longer applied in Europe. The last one being Germany, which went on to a gold standard, I think, in 1873, thereabouts. That meant that the value of silver was then being priced for its next use. And so the gold-silver ratio from that point rose from 15, 16, whatever, on the way up. And of course, it peaked under President Trump in his first term in office at something like 120, and it's now on its way back down again. And this is particularly important because if I'm right about the relationship between gold and precious metals, then we are going to see silver recover very substantially, and not the only one, even measured in gold. Of course, everybody concentrates on silver because that is if you like, the second most important monetary metal in the absence of fiat currencies. So, you get loads and loads of bulls, if you like. So, pessimists like me thinking, if we're going to have a currency crisis, or it's the end of the fiat currency era, then silver's going to come back. I think that will probably fuel some speculation, but I think the main point which everybody is missing is that it's not just silver, but it is all the other base metals which have been suppressed by the fall in the purchasing power of fiat currencies. So much so, they can even quadruple against gold just to return to normality. And what does that mean if gold continues to rise against the dollar? In other words, the dollar continues to fall, pushing gold-dollar values even higher. Well, it means that when it comes to inflation inputs, if you want to look at it in more conventional economic terms, those inflation inputs are going to be very destructive of fiat currencies, horribly so. That's the future, I'm afraid. And what does that mean for bond yields? Oh, up, 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 up. And it's got nothing to do with the collapse in economic activity that will happen. That's going to happen. Partly because of the adjustment, but also because of the past history of suppressing interest rates and the accumulation of unproductive debt. They're missing the most important thing, of course, which is against what? Okay, in real terms, but it's already it's already suppressed in gold terms, which are real terms. And then when you put an overlay of a devaluing, debasing fiat currencies on top of that, then measured in those, it's gonna, this is a disaster. It really is.
And why do you think it's been suppressed then for so long?
It's a function really of the fiat currency regime that really has been in place ever since 1933-34, when gold, in early 1934, the dollar was devalued by 40%. In other words, the gold exchange rate was raised to $35 from 20.67. That sort of held all the way through to 1970, when finally the expansion of the monetary base, if you like, the expansion of unproductive dollar debt really meant that the relationship at $35 became virtually impossible to maintain. I mean, and bear in mind also that the Americans had reduced their holdings of gold from 1947-48 from, I think, something like 22,000 tons, down to 9,000 tons in 1971, when finally they threw in the towel on the gold standard, or what sort of passed for a gold standard. And since then, we've had a fiat currency. It started off with the US Treasury going on a propaganda campaign saying, gold is no longer the standard. We went from a fixed exchange rate regime to a floating exchange rate regime. The dollar was the king currency. Okay. And it sort of got to the point where, this rubbish, this propaganda was so believed that they were even describing gold as a pet rock. It's no longer part of the system. But the interesting thing is that now nobody's talking about gold at all. We just don't want to talk about it. We don't want to talk about it. But as I say, you can go back to the Emperor Diocletian, who introduced an edict of maximum prices. That was around about 270 odd or 300 AD. A long time ago, 1700 years ago plus. And you can look at those prices. Okay, the slave markets no longer operate, so there's no comparison there. But you look at things like, beer, wine, clothes, all these things, they're similar price today, measured in gold. The thing that's changed, of course, is that currencies come and go. And every one that comes, goes. Because what's currency is credit. And eventually, the credit becomes worthless, or it becomes a question, and it has to die. That's what happens.
When we speak about the purchasing power of gold, we're not discussing an arbitrary number on a chart. We're talking about an anchor, something that has outlasted every government, every fiat experiment, and every school of Keynesian fantasy economics. Gold has retained its purchasing power across centuries, not because it's shiny or because central bankers say it should, but because it is the only form of money that is not simultaneously someone else's liability. That truth becomes ever more apparent in a world drowning in debt and denial. Now, of course, prices of individual commodities will vary when measured in gold. Some will rise, some will fall. Technology changes, minds are exhausted, tastes shift. That is the nature of a dynamic world. But what doesn't change is the average purchasing power of gold across a diversified basket of goods, especially base metals. Take copper, tin, nickel, lead. When measured in gold over the last 150 years, their purchasing power has been astonishingly stable, save for brief periods of war or policy distortion. In contrast, the dollar, well, that's another matter entirely. Since the Fed's creation in 1913, the US dollar has lost roughly 97% of its purchasing power. Imagine losing 97% of anything and calling that a success. Let me walk you through a historical case. Back in the early 20th century, when the dollar was still on a gold standard at $20.67 per ounce, a gentleman's suit cost about 1 ounce of gold. Today, with gold trading near $2,400, a high-quality suit still costs around that amount. But the dollar, it's buying you increasingly less. You see the problem. What gold tells us, what it always tells us, is that the currency measuring stick is broken, not the price of the goods being measured. Consider the period from 1950 to 1970, when the US dollar was supposedly fixed to gold at $35 per ounce under the Bretton Woods system. During that time, dollar credit expanded far faster than gold reserves. This set off a pressure cooker that eventually exploded in 1971 when Nixon closed the gold window. Why did he do it? Because the gold was leaving the vaults. Foreign central banks saw the writing on the wall and wanted the real thing, not promises. France under de Gaulle even sent a battleship to retrieve their gold. Yes, a battleship. That's how serious gold was. It still is. And what has happened since the end of Bretton Woods? The purchasing power of the dollar has fallen off a cliff. Yet central bankers will tell you inflation is well anchored. Anchored to what? Delusion? CPI measures are manipulated, hedonic adjustments abound, and asset bubbles are now the preferred economic stimulant. But here's the uncomfortable truth. Gold has not risen in value. Fiat currencies have fallen. And when you strip out the distortions and price suppression schemes, the real value of gold in terms of what it can buy remains roughly constant. Meanwhile, base metals, measured in gold, have declined 70% from their 1900 levels. Let me repeat that. 70%. That's not efficiency, that's a warning. In fact, base metals have so underperformed when priced in gold that we're now looking at a potential 400% increase in their value just to return to historical norms. And if fiat currencies continue their descent, which they will, then the nominal increase in dollar terms could be dramatically higher. That's not a gold bull market, that's a fiat death spiral. Now, Keynesians will argue this is all just supply and demand. They don't understand purchasing power as a dynamic concept. They believe that demand falls in a recession, and so prices must fall, but they ignore the other half of the equation, the value of the currency in which prices are measured. That's the elephant in the room. When fiat money loses credibility, prices rise regardless of economic activity. It's not inflation, it's repudiation. And it is coming. Look around. Inflation inputs are quietly entering the system through the back door. Despite widespread concerns about recession, commodity prices are beginning to firm. Why? Because investors are slowly realizing that fiat currencies are not a store of value. They are political instruments. And politics is a notoriously poor compass for monetary stability.
The purchasing power of gold is relatively constant. Now, obviously, individual commodities, some will rise and some will fall. There will be differences, if you like, because of in demand and also supply, new mines and mines being exhausted and, fashion, or if you like, new technology moving on into other materials. So you'll get all this sort of evolution, if you like, going on. But if you take a sort of a basket of base metals, then quite obviously there is a level where those base metals will be priced in gold relatively constantly over time. Now, there can be some variation of that. I mean, in wars, for example, and also in the 1950s, when there was some significant strains, 50s and early 60s, there was some significant strains as the dollar, was being expanded. Dollar credit was expanding very, very rapidly, yet it was stuck on a gold standard at $35. The result of this was that prices rose, but because you had that $35 relationship with gold, between the dollar and gold, it meant that as prices rose in dollars, it was taking prices up in gold as well. And so we got to a point where prices had risen by roughly 150% on two occasions. The third occasion when this happened was in 1970. And that led to the breakdown of the Bretton Woods system. I mean, this is, if you like, one of the things that you see, if you like, when the system is under strain. Now what's happened, of course, is that with the purchasing power of the dollar falling and falling and falling since the end of the Bretton Woods, we now have a situation where the purchasing power of the dollar has gone down, which means that the price of precious metals has risen, but they have not risen enough to reflect the fall in purchasing power of dollars. What we have as a consequence is we have, if you like, take the 1900 price, which actually held pretty much all the way through to the early 1930s for an index of base metals. That has now fallen by something like 7% from that 1990 level measured in gold. We go back to the long-term purchasing power of gold being constant. Now, this tells us that it's not gold, if you like, that is too high. It's base metals, which are too low, measured in gold. They will recover measured in gold, and they've got the potential to increase by some 400% in gold alone. Now, what does that mean in dollars? Fiat dollar. It means that the increase in fiat dollars is likely to be considerably greater than 400% for an index incorporating a wide range of base metals. So commonly we think in terms of inflation rather than the debasement or the loss of purchasing power of the currency. But what it means is that we've got huge drivers of inflation in the back, which are just beginning maybe to come through. And of course, the Keynesians find that this is something they just don't understand because they just think in terms of supply and demand. They don't think of in terms of any variation of the purchasing power of a currency other than maybe modified by the retail price index or consumer price index or whatever.
Let us now move to the gold-silver ratio, a topic that receives attention from time to time, but not with the analytical rigor it deserves. The historical average, when anchored to a monetary system not utterly debased, has hovered around 15-1. Even through much of the 19th century, when major European powers operated on a bimetallic or gold standard, the ratio stayed relatively stable in the 16-18 range. What changed that? The abandonment of silver as money. Germany's demonetization of silver in the 1870s initiated a cascade, culminating in a global gold standard. From then on, silver's value was determined not monetarily, but by its utility in industry and by speculation. Fast forward to today, and we see a ratio that, as recently as a few years ago, touched 120 to 1. That isn't a price signal. That's a distress flare. Silver has, for decades now, been systematically undervalued. It is not merely a monetary metal in the shadow of gold. It is a strategic material indispensable to modern industry. Whether you're talking photovoltaics, 5G infrastructure, electric vehicles, water purification, or even missile guidance systems, silver is there. And yet, what is its price? Suppressed artificially by Western financial institutions that continue to trade massive paper positions on exchanges like the COMEX and the LBMA, vastly exceeding any physical silver they actually possess. This is not market efficiency. This is price control masquerading as liquidity. I would submit to you that what we are witnessing is not simply an economic mispricing, but a structural failure of the financial system to account for physical reality. That is why I believe the gold-silver ratio will collapse back down toward 50 and quite possibly even lower. If we dare to speculate within historical boundaries, we could see it reach 30 or even 20, especially in a true monetary reset. Let me make this point more concrete. When you see central banks around the world loading up on gold, they are not hedging against volatility. They are hedging against the collapse of trust in fiat. Look at the People's Bank of China, the Reserve Bank of India, even Turkey. None of them are buying gold ETFs. They're not taking synthetic exposure. They're taking delivery. Gold bars vaulted. Why? Because they know what's coming. Now let us speak plainly. The fiat currency experiment, the floating regime born in 1971, when Nixon closed the gold window, has run its course. It has delivered exactly what one would expect from a system that divorces currency from discipline. Rampant debt accumulation, grotesque financialization, and ultimately the destruction of purchasing power. And yet, astonishingly, mainstream economists still marvel at why inflation doesn't behave the way their models predict. Well, their models are wrong. They are built on fallacies like the idea that consumption drives economic growth or that money is merely a veil over barter. It's not. Money, true money, is the measure of value. And when that measure is corrupted, so too is everything denominated by it. If you examine the pricing of base metals, it tells a sobering story. Measured in gold, many base metals are trading at levels 70% below where they were in 1900. Think about that. In nominal fiat terms, the prices have risen, but when you strip away the currency illusion and measure them in sound money, you realize just how severely they've been suppressed. This tells us two things. First, it tells us that gold has maintained its purchasing power over time. That's not news to some of us. Second, it reveals that there is enormous upside potential in the commodity complex, especially in real money terms. Let me walk you through an example. Take copper. In 1900, a ton of copper cost approximately 0.8 ounces of gold. Today, it's closer to 0.2 ounces. That suggests a 400% potential increase in real terms, and if fiat continues its decline, the nominal price will move even higher. The same logic applies to nickel, tin, zinc, and of course, silver. If you are looking for asymmetric opportunities in a world of symmetrical risk, start there. Now, one could argue, but Alasdair, surely these things are priced rationally by markets. And that's where I must interject. No, they are not. Not when central banks intervene daily. Not when interest rates are set by committees rather than markets. Not when trillions in derivatives swamp real-world trade. This is not capitalism. It's command finance dressed in market clothing. Let's pivot to interest rates for a moment. People often misunderstand what drives rates. They think it's inflation expectations or central bank policy. In reality, it's risk. Risk of repayment, risk of currency debasement. As that risk rises, so must yields. That's why bond markets are now groaning under the weight of unsustainable promises. If you think a 5% yield on the 10-year is high, wait until markets demand 8% or 10% just to compensate for the inflation and credit risk. And when that happens, the debt pyramid collapses because it can't be rolled over. What is the Western response to this? More spending, more promises, green transitions, military buildups, universal basic incomes, all funded by debt. We now live in a fantasy land where deficits no longer matter, and any problem, no matter how complex, is solved by issuing more IOUs. It's not just imprudent, it's suicidal. And this brings us back to the heart of the matter, gold. It is not merely a hedge. It is not merely a safe haven. It is the mirror in which fiat illusions are revealed. The higher gold goes, the more obvious it becomes that the emperor has no clothes. And this, I believe, is why gold is attacked so ferociously in the paper markets, because it exposes the fraud. We are now approaching the terminal phase of this monetary experiment, and what that looks like, quite frankly, is chaotic. Currency collapses do not happen in a straight line. They happen in convulsions. Argentina, Turkey, Lebanon, Sri Lanka. These are not isolated events. They are the canaries in the global coal mine. Let me read you something I found interesting. A tweet from Luke Groman not long ago said, "The U.S. is running a wartime deficit in peacetime, with declining tax receipts and rising interest expense. The Fed has to choose between the bond market and the dollar. It can't save both." That's precisely the dilemma. Either you defend the dollar by letting the bond market collapse, or you save bonds by destroying the dollar. And from the looks of it, they've chosen the latter. What should you do? That's the question everyone wants answered. First, own physical gold and silver. Not paper promises, not futures contracts, not ETFs that may or may not have the metal. Own the real thing. Second, diversify geographically. If your entire wealth is denominated in a single jurisdiction, you are at the mercy of political whims. Third, understand what is happening. Knowledge is power, and in times of crisis, it is the most valuable asset you can own. I often get asked whether governments will confiscate gold again. My answer is simple. They might try. But it won't be like 1933. The world is too globalized, too interconnected. You can buy gold abroad, store it abroad, and convert it into anything from Bitcoin to real estate to oil. The tools of control are not as effective as they once were. And besides, if governments are reduced to confiscating gold, that's not a monetary policy. It's a death rattle. Let me close with a quote from the economist Ludwig von Mises. He wrote, "The final outcome of the credit expansion is general impoverishment." That is where we're headed if we continue down this road. The choice is not between growth and austerity. It is between honesty and collapse. Thank you for watching, and for those of you who've stayed with me to the end, I'd encourage you to read further, ask questions, and prepare. Not with fear, but with clarity. The age of illusions is ending. The age of real money is returning.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.